I'm not a fashionable person. I don't really know how to set my hair. I don't really know anything about hairstyle. So yesterday I went for a haircut as my hair was getting a little bit longer and messier. And right after I got my haircut, 3 out of 3 persons who saw me said that my haircut is really bad. I don't know, this could be one of the worst haircut I've ever had in my life. If you think that my haircut is ugly, is bad, just ignore my hair while watching this video. But what's even worse than my haircut is the Russia-Ukraine conflict. This is perhaps one of the biggest news in the world right now as Russia attacked Ukraine, which means war. I'm not here to talk about politics, and of course, being a finance-related channel, I'm here to share my thoughts on the markets and more specifically, how to handle a war-based market crisis. So yesterday, once Russia attacked Ukraine, I started preparing this content. The market was already in a bad shape with the index futures fell more than 2% after Russia invaded Ukraine. Considering the S&P 500 has already fallen by 11.91% year to date, this year is definitely not going to be a pleasant year for a lot of retail investors and traders out there, as we already know that the market would probably go lower and the loss will be extended. And the crash also happened on the cryptocurrency market, which has already suffered more than 50% drop from their all-time high. Dear hodlers out there, you need a strong heart and a solid plan. This video is right now being recorded in the next morning of Malaysia time, and basically the market closed green yesterday and cryptocurrencies have also gone up in price, basically they rebound. But again, all these do not mean that the market is going to recover right at this point. A war is never pleasant to the majority because it introduces a lot more negative impacts than positive impacts. As an investor and trader, we need to know how to protect our interests and maybe potentially profit from the market or potential market crisis. But before we proceed any further, here's just a quick disclaimer. I'm not a licensed financial advisor, and things I'm going to share in this video are not financial advice. I'm just a random dude on the internet with some cameras and microphones. Now, just a little background. I have both investment and trading portfolios. As far as trading is concerned, I use the trend following method to trade the market. And ever since the end of last year, the market has been sluggish and the trend starts bending down earlier this year. I did have some trades going on this year, but the risk I was taking is significantly less than before. So from a trend follower's perspective, I already sort of know that the market is sluggish and probably going to turn down. I would usually reduce the risk of my trading portfolio either by reducing the risk per trade or simply withdraw some money out from the portfolio to prevent some itchy fingers. And when trading doesn't make sense, as in the stock market does not favor long-only position trader like me, basically I would get ready to build up my investment portfolio. Now, of course, building an investment portfolio doesn't mean that we blindly buy whatever we like. We still need some solid plans because the market can take a while to bottom out and there is no way to forecast where's the bottom. Any prediction made is just an educated guess, and an educated guess is still a guess, so I would say planning is more important right over here. So ever since earlier this year, my focus has been shifted to focus in building my investment portfolios for both the stock and cryptocurrency. To get ourselves prepared for the war-based impact towards the stock market, history is our best teacher. To get ourselves prepared for the war-based impact towards the stock market, history is going to be our best teacher. Now, some might argue that history is history and things might be different, the war might be different this time around, and so on. Now, I would say that things are definitely going to be different. Where the war happens and the degree of the war is going to be different. But at the end of the day, we are in a financial market. We are dealing with the same thing over and over again, which is human emotion. And it directly and indirectly affects the price trend and market movement. The only thing is that the volatility of the market can be higher during such time as technology advances. Buying and selling in the stock market is becoming easier nowadays, especially for people like me who lives outside US to participate in the US market activities. And also, we have more electronic or algo trading nowadays that increases the overall market activities and therefore volatility. The focus of this video will mostly be the stock market. Specifically, I'm going to use the Dow and the S&P 500 as it is easier to use these as a comparative point. So let's begin with World War I, which started in 1914, July 24th. The war basically grounded businesses and stock exchanges were closed. Yes, you heard it right. Exchanges were closed, which I think is less likely to happen in this era. Now, although stocks could not be traded on the exchanges, those who are desperate enough to sell can still sell over the counter. Despite the closure of New York Stock Exchange between July 30th and December 12th of 1914, stocks were quoted by brokers and traded off the exchange, which means over the counter. The Dow fell more than 30% during this period of time. When the exchange reopened on December 12, 1914, the market has already bottomed out and it did not revisit this low until the Great Depression in 1932. And I think it is also worth mentioning that prior to the World War I, the market was not actually in a bull run, which means it was not trading at the all-time high. And also do not forget that World War I actually ended on November 11th, 1918, but the stock market has already started going up during December 1914. So in 1914, the Dow has a calendar year drop of 5.43%, which means most of the loss has been erased after the exchange reopened. And for 1915, the Dow had a gain of 81.66%. Again, this is a calendar year gain, and this remains the highest annual return on record for Dow until today. 1916 and 1917 were red years, but let's do not go overly detailed as we already know the movement when the war started. Now, to cut everything short, from the start of the war in 1914 until the war ended in late 1918, the Dow was up more than 43% in total, or around 8.7% annually. In case you are wondering why are we comparing or benchmarking the US stock market with the Dow, it is because the S&P 500 has yet to be launched. The S&P 500 index began only in 1926 as the composite index comprised of only 90 stocks. It is not even S&P 500. And in 1957, the S&P 500 started adopting 500 companies, just so you know. Then only it is called S&P 500. Now let's move on to World War II, whereby the market outcome is quite similar in a very counterintuitive way, I would say. Now, Hitler invaded Poland on September 1st, 1939, and that's when the World War II began. The market opens on 5th September, and guess what? Dow was up by almost 10%. After that, the market did not crash until the next year, May, whereby Hitler invaded France. The Dow crashed by about 25% in just 8 days. After that, the war continued, but the market went up by around 25%, counting from the bottom to the top over the course of 6 months before the market starts declining again. During the Pearl Harbor incident, S&P 500 dropped around 11% in a single day after the attack. And then after that, US declared war on Japan. Then during December, Germany declared war on the US, with the US declaring war on Germany as well. Now, I don't want to bore you with just history, but let's just look at the stock market's reaction for this entire World War II from September 1st, 1939 to September 2nd, 1945. Starting from 1939 until 1941, the stock market suffered calendar year losses of 5.45%, 15.29%, and 17.86% respectively. The market actually bottomed out around half year after the Pearl Harbor attack. From 1942 until 1945, whereby the war is still on, the stock market was already in a rally. During those 4 years, the S&P 500 was up by 12.43%, 21.78%, 13.8%, and 30.72% respectively. 4 years of consecutive double-digit gain. Dow was also up by 7.61% on 1942, 13.81%, 12.09%, and 26.65% on the 1945, whereby the war ended. Given that how bad World War II was, especially if you know anyone who directly or indirectly involved in it, the war also involved many countries into the picture. However, seeing things in a retrospective manner, I would say, I think that the impact of World War II on the stock market is not really a complete disaster. The more disastrous incident is what was happening before the World War II, which is the Great Depression, whereby the stock market wiped out all the gains post-World War I in about 33 months, if my memory serves me well. But again, let's just back to the topic of this video, which is stock market movement that caused by wars. After the World War II, there are still a lot of wars happening again, and let's just discuss a few here in this video. In 1950, there is a Korean War whereby North Korea invaded the South Korea. The conflict ended in 1953. During those years, Dow was up by 17.63% in 1950, 14.37% in 1951, 8.42% in 1952, and a decline of 3.77% in 1953. S&P Composite Index, on the other hand, performed very similarly. 3 years of green followed by one small red year, which are 21.78% in 1950, then 16.46%, 11.78% in 1952, and then a drop of 6.62% in 1953. Now, there are many small wars after the World War II. Well, small war as in they are not labeled as World War. Nobody wants a war anyway. Alright, let's just say this. There are many wars or geopolitical conflicts after the World War II, just like we always have conflicts as long as we are still living our life dealing with human beings. But after a war or any geopolitical event, the market always go up in a considerably short time, I would say, comparing to other type of stock market crisis trigger. I'll attach a table here showing the stock market reactions of the past wars or geopolitical conflicts. And we can actually see that the Pearl Harbor event took the longest to bottom out and recover. Again, comparing these to the Great Depression, all these were just small cases. I really hate history. Alright, so now correct me if I'm wrong, but there is no official World War III yet. We never know how the Russia-Ukraine conflicts or war will escalate, but at least from the history, we kind of see some pattern right over here. War and conflicts will most probably bring crash to the market. How the market crashes may vary. Some will just flash crash, while some will gradually decline over a couple of months. This is very understandable because when uncertainty increases, investors will pivot their capital to asset classes that are safer, which is very normal. One thing that is quite consistent is the market recovery. The market will definitely recover, and for the most part, the market will bottom out even before the war or conflict ends. Now, come and think of it. The market crash in 2020 that has just happened is believed to be caused by the COVID-19 outbreak. But the market bottomed out in less than 30 trading days, but the COVID-19 outbreak does not stop in 30 trading days. I use the word does not because the COVID is still here. Now, of course, there are a few problems here. Each and every conflict is different to some extent, although we are dealing with human emotions in the market after all. The market crash can be caused by a hybrid of many problems. For instance, right now it could be the Russia-Ukraine conflict together with the high inflation that has yet to be solved, alongside with the COVID-19 cases number that is still growing due to the mutation of the virus. We never know the true causes. Whenever the market has some kind of movement, most of the investors and traders out there will focus on asking why. Why is this happening? Why is the market crashing? The truth is, we can never really know why the market is moving a certain direction because the market is going where it wants to go. Now, asking why is good because it shows the interest of a person towards understanding the market, but this should not be the only questions you should ask. And to me, honestly, it is close to pointless to ask too much whys, as this would usually lead to a wrong direction. Let me ask you, why the market recovered even before the World War II ended? Why the market recovered from a crash that is believed to be caused by COVID-19 outbreak even before COVID-19 stopped and even before we discovered the vaccine? Even if you could answer all these whys, the thing is, it has nothing to do with your portfolios. The more important question to ask, in my opinion, is actually what's next. We got to have our own plans. Actionable and executable steps after analyzing the situation is more crucial. If the market recovers next week, what's your plan? And if the market really crashes and only recovers after a year or two, what's your plan? If the market really recovers starting from today, then what are you going to do? Finding out the whys can be very important, but it has nothing to do with our investment and financial goals. The plans are still more important. So historically, the Great Depression is the market crisis that I would say is the most disastrous, whereby the entire market has a cumulative drop of more than 80%. The Great Depression started on 1929 until around 1939, whereby we have a World War II. So economically, the Great Depression lasted for a decade. However, the stock market suffered the 80+% loss in just about 33 months, measured from the top to the bottom, which is just about 3 years. Some people would say that the stock market is a leading indicator of the economy. That's why we always see the stock market recovered and started rallying way before problems are actually solved. This is what we learn in economics as well. I don't think this is the right way of seeing things. You see, for the Great Depression, the market bottomed out in 1932, which was like 7 years before the actual Great Depression ended. So the stock market led by 7 years. I just don't think it's a logical way to see things in general. So instead of thinking it as a leading indicator of the economy, I would rather think that the stock market has little or nothing to do with the economy from a practical standpoint. But of course, if you're doing your assignment right now, don't quote me on this. Of course, things can be different because every war or conflict is different, as we have the war, the COVID, the inflation, and the list goes on. Since every time things are going to be different, it means the same. Here's why. If every crash is different, then actually it doesn't make any difference. If we keep thinking that every time things are different, then we can easily fall into the vicious cycle of thinking that, oh, this time around is different, and we demand a different strategy, and the strategy has been backtested for literally 0 time because this time around is going to be different, if you get what I'm trying to say. So my plan is the same. Every time the market drops a certain percentage, I will buy and accumulate based on sizing that has been pre-planned based on my available capital, and these investments are for long-term investment portfolio. Understand that the market goes up and down, and regardless what happens, the market will eventually recover and break new highs. Well, of course, it takes some time to break a new high. We are most probably going to see some more downward movement right now in the market, but the market fall will eventually stop somewhere. And of course, I do not have a crystal ball in front of me. I couldn't tell you when the market is going to bottom out, but based on the history, we can roughly get some estimates and mentally prepare for it. And also, if we put the Great Depression aside, the maximum cumulative loss on recessions or crisis is actually 50.9%, and that was actually the subprime mortgage crisis. For the Great Depression, the market suffered a cumulative loss of 83.4%. So again, the question that we need to ask ourselves is, what's next? If the market were to drop by 50%, what's our plan? And do you think we are going to have another crisis like the Great Depression, whereby the market drops by 80% again from the all-time high? And if that were to happen, what's our plan? Are you going to do nothing until the market truly recovers, or are you going to treat this as an opportunity and start building your investment portfolios? If yes, then how are you going to do it? Because we never know when's the market bottom, and we can only know that the market is already bottomed out until we can see things in a retrospective manner. Again, I do not have a crystal ball with me, but there is one thing that is quite certain. The market will recover somewhere. The only variable is time, and this is the thing that we need to mentally prepare for it so that we can control our emotion accordingly. With this crash aside, I view this as one of the greatest opportunities in my journey. And in my opinion, this could be one of the best timing to pave our way to build a solid foundation for our investment portfolio, because this could be an opportunity to really collect things at a bargain. Of course, we never know how low things will go, but we know that few years from now, things could be higher. Think about it. Imagine you have collected enough SPY or QQQ, which are the ETF for the S&P 500 and Nasdaq 100. Now, if you do not know what they are, you can click the YouTube card right over here to watch my video on the ETFs to begin investing with, especially for beginners. Now, what you can do after you have your first 100 units of SPY or QQQ is actually selling call options to generate cash flow. And this strategy is known as covered call. If your average cost price of the SPY or QQQ is low, then your yield of doing covered call would be higher each time. Now, for example, if you were to collect premium, say like $2 by selling 1 unit of QQQ call option, so if you sell 1 full contract, that would be like $200 worth of premium collected. Your yield would be completely different if your average cost price, let's say for QQQ, is $330 per unit versus say $400 per unit. So I would say this is much depending on what you want to achieve for your investment portfolios or whatever portfolios. For my stock trading portfolio, definitely I will wait until the market recovers. As for my investment portfolio, I have a different goal. I'm committed into a long-term plan, long-term capital appreciation plus cash flow generation. And that's the reason why I personally think that this might be one of the greatest opportunities, if not the best, for people who have similar goal to me as far as this investment portfolio is concerned. So previously, I have also made a video outlining 3 investments that I will personally make should the market crash this year. I will link it on the YouTube card again and also in the description below. Be sure to check that video out if you haven't already. Now that was part of my plan as well, and the market is definitely declining right now. As for cryptocurrency, it is still a new thing as we do not have any war for us to see how it can affect the cryptocurrency market. But what we can use as a reference is the Bitcoin or the cryptocurrency fall from somewhere in December 2017 to December 2018, which is about like 84% drop, and during that time for Bitcoin, 84% drop. And during that time, many people have lost their faith in cryptocurrencies. So what you should ask yourself is whether or not you have conviction for cryptocurrencies, and specifically which cryptocurrencies do you want to invest in. And the next question is, if the cryptocurrency market were to drop another like 80% in a year or two, what would be your plan? In fact, I just posted a video on strategies to invest and accumulate cryptocurrencies without market timing and speculation. So make sure you check that video out. Again, I'll link in the YouTube card and also in the description below. So make sure you check out after watching this video, because this video is about to end. So understand that things remain uncertain for now, and we never know how things can escalate, despite we see some greens on the first day after the war is declared. Following the latest news can help, but that's not everything, as I have already explained that things can even recover before the problems are solved. So the more important thing is having a plan. Again, these are just my sharing and they are not financial advices. So do your own due diligence every time you consume such content in the internet. With that said, that will be all for this video. If you love content like this, be sure to subscribe to my channel for more, turn on the notification bell, and I will see you when I see you. Peace out.